US markets trade defensively ahead of Liberation Day as weak manufacturing and US jobs data raises fear of a slowdown. The Reserve Bank of Australia holds rates as others are cutting, and Australian consumer confidence ticks up while retail sales kept recovering. That's coming up in our 5 Things in 5 Minutes on Wednesday, April the 2nd. And then in today's bonus deep dive interview, ANZ Head of Asia Research, Khoon explains why Asian economies may be particularly nervous about Liberation Day's tariff announcements and how they might react.
China in particular has been trying to retaliate, but I think for the rest of Asia, they probably won't want to go down the retaliation route because it's just going to potentially make matters worse.
But first, in 5 and 5 with ANZ, US stock markets traded defensively ahead of an imminent report on US trade and then Liberation Day's reciprocal tariff announcements. Strength in tech stocks held the S&P 500 up 0.3% at 4 a.m. Sydney-Melbourne time after it fell earlier in the session because of weaker than expected manufacturing data for March and cooling February jobs data, which adds to fears of an economic slowdown. ANZ Head of G3 Economics, Brian Martin, says all key subcomponents of the ISM manufacturing survey for the US were weak.
That would indicate a manufacturing sector that is nervous about tariffs. In addition, we had the job openings data. They showed a further easing. They fell 194,000 in the last day of February to just below 7.6 million. That took the ratio of job openings to unemployed people to 1.07, down from 1.13. So the labour market seems to be softening ahead of the tariff announcement as well.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was trading flat with the US 10-year Treasury yield down 8.5 basis points. The Aussie dollar was trading up 0.5% at 62.74 US cents, while the Kiwi was up 0.4% at 56.99 US cents. Gold was down 0.3% at $3,140 an ounce, and West Texas Intermediate futures were trading down 0.1% at $71.08 a barrel. Number 2, the Reserve Bank of Australia held the cash rate steady at 4.1% yesterday, as expected. ANZ's Head of Australian Economics, Adam Boyton, says the RBA board maintained a more hawkish stance on domestic activity than priced in by the market, while increasing its focus on global uncertainty.
From the perspective of the domestic economy, little change since February. From the perspective of the global economy and global policy uncertainty, certainly that has changed since February. And I think if the Reserve Bank does end up easing more than we at ANZ expect, it will be because the bank has decided to respond either to that global uncertainty or alternatively if that global uncertainty manifests itself in weaker growth.
Number 3, Adam says ANZ Research continues to expect one more rate cut, likely in August. But he says the RBA board provided itself with optionality in the post-meeting statement regarding future moves.
They still think labour market conditions are tight. And I think if we see a continuation of, in their view, tightness in the labour market, plus the domestic activity remaining solid and inflation printing, say, around the 0.7 for the trimmed mean, when we get that toward the end of April, then that certainly can be enough to hold the bank's hand in May, as we expect it will be. Alternatively, if the global environment is sufficiently more negative, then it's possible the bank may act more aggressively.
Number 4, ANZ Roy Morgan Australian consumer confidence edged up 1.1 points in the last week of March, although continued to sit below its 2025 average. Here's ANZ economist Sophia Angala.
We did see rises in households' confidence in their current finances and in their economic conditions over the next year, after these indices had falls over the previous 2 weeks. But households' confidence in their future finances and their economic conditions over the next 5 years are still below the averages that they held over the second half of 2024.
Number 5, Australian retail sales grew 0.2% in February, slightly softer than market expectations. That followed a 0.3% rise in January. Here's Sophia again.
Our measure of the pulse of retail sales is the 6-month annualized figure. That fell in February, but it is still above the 5-year pre-COVID average, affirming that consumer spending growth is recovering. And that's something that the RBA is expecting. So we continue to expect a pickup in household disposable income from cost of living relief, stage 3 tax cuts continuing to flow through, easing inflation, and the rate cutting cycle to support household consumption through this year.
Sophia Angala there. Now, in today's bonus deep dive interview, ANZ Head of Asia Research Khoon looks at how Asian economies outside of China are placed ahead of the US Liberation Day tariff announcements.
The reason why Asia is a focus is that out of the top 15 trading partners that the US runs bilateral trade deficits against, 9 are in Asia. And China is the largest, but following that, countries like Taiwan and South Korea do run fairly large bilateral trade imbalances with the US, and therefore they are very likely to be potential targets for reciprocal tariffs. And part of the reason why a lot of policymakers in this region is nervous about this is because Asia has significantly increased their direct export exposure to the US over the last decade, the two largest being Vietnam and Taiwan. But just to give you a sense of how much more important the US is for the rest of Asia, excluding China, back in 2017, exports to the US accounted for 3.8% of their GDP. As of last year, that share has now risen to 6% of GDP. So that's why there's a lot of nervousness about what kind of tariffs that the US might impose on Asia.
Why was there such a big change over the last 8 years or so?
Well, part of that is, as you can appreciate, due to the first US-China trade war, we saw a lot of companies starting to shift production and supply chains, try and reduce the direct exports from China to the US. And the rest of Asia obviously benefited very handsomely from that. The China Plus One diversification strategy saw a lot of new investments pouring into countries like Vietnam in particular, and India and Malaysia. And as a result, those countries have seen a significant uplift in their exports to the US.
Now, some countries don't necessarily have trade surpluses with the United States and also have relatively low tariffs, including countries such as Singapore and South Korea. Are they immune, therefore, from action or effects?
Yeah, so on the face of it, South Korea and Singapore are two countries in Asia that have a free trade agreement with the United States. In the case of Singapore, Singapore actually runs small trade deficit against the US. So again, on paper, it suggests that these two countries might not feature very highly on the reciprocal tariff list. However, President Trump has indicated that the administration is not just looking at the respective tariff rates, but also non-tariff barriers, including VAT and potentially the exchange rate management of those countries involved. And in this particular case, particularly around exchange rate management, there are 6 economies in Asia that are in the US Treasury's monitoring list, which includes Singapore and South Korea. So it is possible that those other non-tariff barriers and VAT and exchange rate practices could be used as an excuse to impose reciprocal tariffs even against Singapore or South Korea. We simply don't know. There's a lot of leeway that the administration can use to justify some form of tariffs.
And how might these economies respond? Although when we do this interview, we don't know exactly what has been applied, but what types of tools could be used?
The immediate response, as we've seen with China in particular, has been trying to retaliate. But I think for the rest of Asia, they probably won't want to go down the retaliation route because it's just going to potentially make matters worse. What some countries like India, for example, has started to do is they've started to unilaterally reduce some of their tariffs against US products. And Vietnam has indicated they're going to do something similar in regards to some of the imports from the US, and they've also committed to buying more, particularly energy imports from the US. But in terms of other policies to try and blunt any impact on trade, fiscal and monetary are typically the most common ones. So we might well see further interest rate cuts from the region, although I think there's a limit to how far interest rates can probably be lowered. Fiscal policy also has some constraints, given that some countries are still trying to improve their overall fiscal position. So what it probably boils down to is that the exchange rates will probably need to bear most of the burden of the adjustment, meaning there's probably going to be more pressure for Asian currencies to depreciate to try and blunt some of that tariff impact.
You can go there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, April the 2nd. Catch you tomorrow with further analysis of the Liberation Day tariff announcements. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.